Welcome back to Smart Investing Show, and this is the part we talk to our financial planner, Harrison Johnson, the CFP. Always has great topics. A lot of times, like, no, Brent, you don't qualify for that, but you always have great topics for everybody else, so I appreciate that. Today we're talking about the challenge of creating retirement income, and when I saw this, like, I know this is a big problem for a lot of people, isn't it?
It's a big problem, and a lot of people don't think of it as a problem because you go from working and accumulating money largely, you're putting money into your 401k every 2 weeks or whatever it is, and you do that for a few decades and you wind up with this big pile of money, and now the question is, what do you do with it? Well, I've got a lot of money, so it's going to be fine. Well, the actual creation of income from assets is a lot different than what it is when you're working and just adding to it. So doing that efficiently means you don't run out of money, or you get more money out of your assets than hopefully enough to live on and have the lifestyle that you want. So a lot of people look at different things of putting their money in when they retire. CDs and treasury bills have been a little bit more popular recently because the yields are slightly higher than they have been, but they're 4% or so. But you're not getting any appreciation from that, so they're not inflation adjusted, and short-term rates are probably going to be coming down at some point. So 4% now might be 3 or 2% at some point in the future. So it's not a consistent long-term income stream. Corporate bonds are another thing that people look at to create income, but really the long-term return of them isn't that much greater than CDs and treasury bills are. And they have all the risks: interest rate risk, credit risk, duration risk, reinvestment risk. So you might get a little bit more long-term return, but you can lose money in bonds. So, the 10-year return of bonds has not been good at all. Yeah. Annuities is something else people look at. Annuities are basically pensions. You can create pension-like income with annuities, but now you're doing it with an insurance company, and they're creating those to benefit themselves, not you as the investor. So you really don't make that much money. In many cases, you lose a lot of money with annuities in terms of the income stream, because you have to live so long just to get the money back that you put into the annuity.
And that's because of the inflation adjustment. I mean, it doesn't keep pace with inflation. I mean,
usually they don't. No,
right.
You can get an annuity through an insurance company that has an inflation adjustment, but that means you're starting out with much less. So, it's all actuarial tables. And again, the insurance company is doing it to make money. And so, yeah, here's $500,000, here's $1 million insurance company, and they'll give you some of it back. And if you live to be 300 years old, you'll get money back. But if you don't, in many cases, you can lose money. The break even is 10 to 20 years in many cases on those things, and then only then do you start making money. So your actual total return is never good, because the yield is just it's impossible based on the yield that they give you. Another thing people look at is, well, I'll just invest in high dividend stocks. So maybe that'll work out. And that sounds a lot better than it really works out to be in practice. And one of the problems that you have with dividend stocks specifically is, in many cases, companies that pay high dividends might be struggling and stock prices might have come down. And so the dividend yield might look high, but that's only because the stock price is down.
Right.
And so, because of that, if that company is struggling, if you're not looking at all the other fundamentals of it, and they are forced to cut the dividend, well, that can hurt the stock price even more, especially if people are holding that purely because of the dividend yield. So if they cut that out, those investors go elsewhere. And, long term, you can, be chasing yields and not really make that much money if you're only looking at that. The opposite side of the spectrum is, the NASDAQ, the S&P, things like that. People have done well investing in those, especially if that's in your 401k and you just put it in there and it's grown, not to mention the risks that you guys have talked about with the earnings and the concentration and everything else. But the dividend yields on those, on the S&P, dividend yields like 1.1, 1.2%, and the NASDAQ, it's like 0.8. So it's really not much at all. So if you're needing income, you have to sell, and you have to sell a lot consistently. So now you're trying to time when to sell, how to sell. And if you do that inefficiently, you can deteriorate your portfolio if you're selling at the wrong time, or if you need to withdraw money because you're in retirement, you sell at the wrong time, that can really hurt you really quickly. Even like dividend aristocrats that a lot of people think are great investments, and, depending on how you do it, I guess they can be, but dividend aristocrats are companies that have a history of increasing their dividends over time, but the yield on those aren't as large as you might think. Dividend aristocrats, if you look at all of them, the average yield is like 2 to 2.5%. So it's not like a 7% yield that's increasing all the time. The reason it's able to be increased is because it's the initial current yield really isn't that high to begin with. So if you want more than that, which a decent income portfolio should be able to pay out more than 2 to 2.5%. So all of these things need to be looked at. But the fact of the matter is, creating income is a lot, I would say, more difficult, but it's just a lot different than accumulating money when you're working. And so if you're planning for retirement, you need to have an idea of how, one, you're going to invest that money, and then how really you can sustainably withdraw from that to make sure you don't run out, but also you're getting as much money out of your assets as you possibly can.
So what happens? Joe Smith comes into you, says, okay, I've accumulated all this money. Now I want to retire. What do you look at to say, okay, this is how we're going to get you so you can have a nice retirement? I know people get scared because it is going to reverse. So now they're taking money, not putting money in. So how do you handle it?
Well, a lot of people struggle with it because if they don't have a plan, the financial plan is a piece of this, but this really works in tandem with the investment plan that you have. So really, both of those need to be working well together. But if someone comes in and they don't have a financial or an investment plan, in many cases, they're just afraid of how much really they can withdraw. And I mean, if you never withdraw any money, you're never going to run out. But what's the point of working for 3-4 decades if you're never going to, use the money that you spent all that time trying to accumulate? So when someone comes in, we need to talk about, yes, what is your plan for your assets, and really how much money do you need? If we can, put those assets in a place, or maybe talk to you guys depending on the situation. Yes, we need that money to grow. Here's how much income we can reasonably withdraw. Also, this is how we will use that to supplement Social Security and when you should collect Social Security. This is how we should, how much we should be withdrawing from the different types of accounts that you have to keep an eye on, the tax perspective, should any be converted. All of those things come into the plan. But at the end of the day, the financial plan around retirement is, how do we get you to retirement with the most income and pay the least amount of taxes on it?
I would just say kind of two things that stood out to me there was, obviously you talk about the NASDAQ, and I've kind of hit on this, but I just want to reinforce it, is, the NASDAQ could have been a great investment during your working years, or the S&P 500 could have been a great investment during your working years if you lived during the last 20 years. But now all of a sudden you switch to that income side. And if your plan is to just kind of take from that investment, again, I like to point out the tech bust. The S&P fell by 50% and the NASDAQ fell by 79%. If you're withdrawing income from a portfolio that crashes 50% and you're fully invested, you're going to run out of money because you're going to have to cash in at low periods. So it's structuring that portfolio is so important. And then I want to hit on dividend stocks real quick too. The most recent one that comes to mind is Dow Chemical. Dow Chemical right now has a forward dividend yield of about 5.7%. It was around 11-12%, but they cut it in half. But that's not the full story. Dow Chemical is down about 54% over the last year. So when you bought it, let's say at the beginning of last year, or 1 year ago, just keep the numbers easy on me, you bought it 1 year ago, you were getting around a 5-6% dividend. Well, now you've gone through a 50% collapse in the stock price, and now your dividend is not 5.7 because that's based off the current price. Your dividend's more like 2.5 to 3% after weathering that 50% plus decline. So you're not going to be at break even because of the dividend. I don't think ever. You're going to need that stock to come back. But it's a difficult strategy that I think a lot of people think sounds easy, but it's not the full story that you need to follow as an investor.
Yeah. And I just want to kind of let that sit for a little bit, because it is important to understand, because people get so excited about things and so emotional. And that's what happens, Chase, when that Dow Chemical drops, 20, 30, 40%, people will panic and sell, and they may sell everything else. Like, stocks are risky, I'm going to get out. They did a silly thing. You've got to understand, because we love dividend paying stocks, but we look at the income statement, we look at the balance sheet, the cash flow, we look at the payout ratio, all these things to make sure that this makes sense. And if you're not doing that, you're just poking in the dark. That's all you're doing.
And I mean, with the Dow Chemical, obviously not every company that has a dividend yield is going to cut that dividend yield, but it only takes a couple of those in a portfolio to really hurt your long-term ability to withdraw a sustainable amount of money. And that's the thing, the rest of your portfolio might be doing fine, but if you lose 50% on this one, 50% on that one, that's, offsetting the other gains that you have in the others. And so now you're just depleting assets as opposed to preserving and growing assets.
Well, the problem is, again, you sell out of that Dow Chemical, because they cut their dividend. Well, now you have half the money that you had before to invest in a different thing. You can't just go say, again, I'm going to use that 5% level. Well, I'm just going to go find something now yielding 10%. Well, oh gosh, that is not a good strategy.
Especially
a losing game.
especially while you are withdrawing money because you're in retirement. So, I mean, when you go into the point of now you're not adding money because you're working, you don't have a paycheck anymore, you're withdrawing money. So mistakes are much more costly because you don't want to have to go back to work, or maybe you can't go back to work. So that's why you need this plan. You need to have a plan ahead of time so you don't make a mistake like that and, you know, not be able to fix it.
And that's why it's so important to have a financial plan. I remember years ago, they said if you don't have a financial plan, you just plan to fail. And you've got to have a financial plan because that makes it so much easier. You're not going to do stupid things. You got somebody like Harrison that's going to walk you through it. Things do happen. Okay, we'll take care of this. But you look at everything. A good CFP, a good financial planner. And again, there's people out there who have CFP behind their name and they're terrible. They just passed a test and that was it. They're not good financial planners. Listen to that person. Again, I always highly recommend. I mean, I think every client you have would give you a high recommendation.
I think so. I
Yeah,
think so. And I mean, a lot of it too, as far as the income goes, is when we put an income plan together for somebody and we say, okay, this is how much you can spend. It's like, wow, that's actually a lot more than I was expecting. That's more than I'm making right now. I guess I can retire.
And you plan for the downturns as well.
Oh, yeah, absolutely. You have to.
Yeah.
You have to. It's not, oh, best case scenario, you can get by this. No. Conservatively, this is what it can be. But that's a part of, you want to get the most out of the assets that you've done.
Right. That's the financial plan. All right, Harrison, thank you very much. Again, that's Harrison Johnson, the CFP. If you want an appointment with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. You do get a 1-hour free consultation to see if you do need a financial planner. So I'd say take advantage of that because you may be surprised what you're missing there.